let's head to Nigeria. The International Monetary Fund says the country is expected to emerge from recession this year with economic growth of 0.8%. But it did warn that threats to recovery remained elevated, adding the economy will not grow enough to reduce unemployment and poverty. Now, the IMF advised the federal government to pursue a policy of fiscal consolidation through higher non-oil revenues to ensure stability and growth. Nigeria slipped into a recession last year as low crude oil prices and production slashed government revenues, causing dollar shortages in the country and crippling the economy. Now, the fund says the government saw significant revenue shortfalls in the first half of the year, with interest payments remaining as high as 40% at the end of June. Now, Gabriel Idahosa, a financial consultant and analyst, joins us in Lagos with some insight into this. Welcome to the show, sir. Now, we know the IMF does see that the economy will come out of recession this year. Many analysts, however, believe that this is contingent on many variables, which of course include foreign exchange, the foreign exchange rate. Now, what are your main takeaways from this report?
Well, essentially, the foreign exchange market now reflects the fact that we have been able to export about 2 million barrels per day, and we have been exempted from the cap by OPEC, and that has helped us to override some of the effects of the recession. But that exemption has been removed by OPEC, so we are likely to see that affecting our capacity to sustain the present level of foreign exchange. That's one of the reasons why there are significant threats to the assumption that we will be able to achieve the growth that the government had projected. And the IMF report is reflecting that fact.
Now, one factor that is important is the fact that the IMF does say that the economic recovery in the first half was largely driven by a recovery in the price of oil and certainly oil production in the country. But how much of a risk is the fact that militants in the Niger Delta are threatening to restart attacks there?
That is a very significant risk. In fact, that's a major risk, in the sense that the assumption in the budget was that for the whole of this year, we would have peace in the Niger Delta and there will be uninterrupted production at that level. But we have had communities in the Niger Delta now saying that they are not happy with government response to their demands, some specific demands, and there are threats to start another round of disruption of oil production. So that's a very significant risk that we are looking at in the second half of this year. And we really hope that government attends to those demands and we do not have disruption of oil production. In the Northeast, also the assumption was that with the success of the military, we will have peace there and significant agricultural production will resume, with most of the displaced persons going back to their homes, and they are predominantly farmers, and we begin to see production from farming in that large part of Nigeria, about 5 out of our 36 states contributing to agriculture. So we have significant threats from those two situations.
Now, another thing analysts do mention is a need for coordination between Nigeria's fiscal and monetary policies. It's, of course, one of the major areas that analysts do point to. Do you agree with them? Do you think this is a major risk also going forward?
It has been a major risk in Nigeria generally, but this government has reduced that. There is some agreement between both parties, but the fiscal authorities are not fully agreed with the policies of the central bank when it comes to interest rates. The Minister of Finance has asked for a reduction in interest rates to stimulate lower cost for the real sector. But the central bank believes that it is not yet time to bring down interest rates. So that's still an area of disagreement between both parties. But in the area of foreign exchange, I think to a large extent both parties are on the same page, the way the foreign exchange market is being driven towards convergence among the various rates we used to have. And to a large extent, if we can get some agreement on interest rates and begin to reduce interest rates at some point, we will begin to see less disagreements between both parties, because you need to bring down interest rates for the real sector to have access to lower cost of funding, because interest rates are quite high now, and most sectors complain that it is too high to sustain rapid growth and investment that you need to create the employment you need to take all of us Nigerians who want jobs out of the streets. So it is important that the government on both sides, the monetary policy and the fiscal policy, find a way to agree on lowering of interest rates. That's a major concern that has not been addressed.
Right. Now, ironically, while the IMF is predicting growth of about 0.8%, Nigeria's government expects the economy to grow by about 2.2% this year. Now, what are your thoughts on the government's expectations? They seem quite positive compared to the IMF.
Well, the government expectations are very, very optimistic in view of some of the things that have been mentioned. If you have significant threats to oil revenues, significant threats, very significant threats to increase in agricultural production in about 6 states in the Northeast, then you are not likely to get the kind of growth we are looking at. Also, revenues from imports are down because we do not have the kind of earning capacity in the economy to finance and buy the products that we ought to import. Also, tax budgets and tax projections cannot be achieved because a lot of businesses are not getting the kind of support they need to grow their business and grow the revenues from which you can tax. So those aspects of the projections are all under threat. So it's really unlikely to see 2.2 at the end of the year, unless, of course, for some reason, we see peace in the Delta for the whole of the year, we see peace in the Northeast for the whole of the year, and we have significant increase in agricultural production across the country without disruptions from terrorist activities, and we are able to get the moderation of our export of crude oil within the levels we are currently doing, and the OPEC allows us to somehow do a little bit more than the cap they are really wanting us to keep.
Right, right. Well, many thanks for those insights. Of course, that was Gabriel Idahos, financial consultant, joining us there in Lagos.